Hello everyone, welcome to Chapter 31 of my in-depth CRT series. In this chapter, we're going to be discussing intraday market conditions. We'll learn about the different conditions and variables that shape the intraday session throughout the day. Then we'll look at how we can adapt to those different structural frameworks for better execution and decision-making. Before we can dive into our setup and entry models, it's crucial for us to understand and recognize the market conditions we're working with. Intraday trading isn't just about spotting an entry model on a lower time frame and jumping into a trade immediately. Instead, it's about recognizing the underlying conditions of the market at any given moment and determining whether those conditions align with our objectives. There could be high probability conditions in which you should be actively looking for trades. On the other hand, sometimes the conditions are not favorable. They're low probability. In that case, it's best to avoid trading altogether. In this chapter, we'll go over all of those conditions, what they are, how they're influenced, and their impact on our execution throughout the day. Most importantly, we'll discuss how you can classify and differentiate these conditions in the most objective and mechanical way possible. Now let's move on to the next slide and break down the concept of probabilities in trading. In this part of the chapter, we're going to understand how probabilities can seriously boost our decision-making process and overall performance as traders. We know that trading isn't about certainty, it's about probabilities. Every trade you take comes with a certain likelihood of success, and your job as a trader is to recognize and act on those high probability setups while avoiding the low probability ones. You can never know for sure the outcome of a single trade because it's never certain. But what you can do is predict the outcome of a number of trades over time by calculating your edge. You've probably already calculated your edge, either by gathering data through backtesting or through live trading. That would have given you a win rate based on your collected data. The larger the sample size, the more accurate your calculations will be. Let's say you have a decent sample size of data from your model or system that gives you an edge. By decent, we mean at least 6 months' worth of data across various market conditions. From this, you've established a win rate. So even though you can't predict the result of a single trade with certainty, you can measure your performance over a large number of trades based on your historical data. This metric, how often you win or lose over a broad set of trades, is what we call probability. It's not absolute certainty, but you have to trust your system regardless. The only way your performance can closely match your edge is if you execute your system with consistency. No inefficiencies or mistakes. Otherwise, any discrepancies will lead to subpar performance. It's simple math, nothing too complex. Now let's talk about high probability and low probability trades. High probability trades are backed by your trading edge. They're aligned with the data you've gathered and are typically seen in conditions that statistically favor success. For example, you might find that trading during key times like the London kill zone between 3 a.m. and 9 a.m. consistently offers more favorable setups. You've learned this through your own historical data. Without that data, you wouldn't know these timeframes were statistically better to begin with. Another example of a high probability setup would be an entry aligned with higher timeframe liquidity and key levels. These are the kinds of metrics that define a high probability trade. On the flip side, low probability trades usually occur in unfavorable conditions, where there's a lack of clear signals or higher time frame market context. For instance, trading outside your key time zones or macro areas is a low probability move. Your data may show that trading outside those times has resulted in more losses than wins. That's not something I said or someone else said, it's what your data said. That's why we classify that scenario as low probability. The reason we consider the 3 a.m. window to be a high probability time is because the data, collected across years, instruments, and different traders, consistently shows key levels being tested or cleared around this time. Whether it's expansions, reversals, or reactions at significant levels, this window statistically supports movement. And we use that data to support our system by classifying this time as high probability. A good example of a low probability scenario would be taking a random trade outside your strategy, perhaps driven by emotion, overtrading, or other mistakes. These types of trades don't align with your edge and typically lead to inconsistent results. Again, the data shows that trades made under these conditions are more likely to fail, so you avoid them and protect your capital. Let's now touch on the importance of understanding probabilities. When you understand probabilities, you begin to shift your focus from quantity to quality. It's not about taking more trades, it's about taking the right ones. Avoiding low probability trades helps you protect your capital while keeping your attention on the setups that actually have the odds in your favor. Secondly, knowing when the odds are in your favor allows you to trade with confidence and clarity. Recognizing poor conditions also helps you avoid unnecessary risk. Third, by sticking to high probability setups, you create a more predictable and stable equity curve over time, one that will begin to resemble the equity curve based on the data you've already collected. This alignment between your execution and your model performance is what we refer to as optimal performance. Now, the likelihood of success in any trade is influenced by several key factors. First, market conditions. Trending markets tend to present higher probability setups than ranging or consolidating ones. If you're intraday trading, your objective is to position yourself within daily range expansions. If you're swing trading, you're looking for weekly range expansions. So naturally, your odds improve in trending environments. Time windows like kill zones or post-news releases often provide better trading opportunities than consolidation periods. Second, consistency in price action. Clean, predictable movements, respecting key levels, following candle structure, and aligning with higher time frame trends tend to signal high probability trading days. This is consistency in action. In trading, your edge lies in understanding and acting on probabilities. By focusing on high probability setups and avoiding low probability trades, you not only improve your decision-making, but also build a more consistent and sustainable approach. It simplifies your trading process and helps you avoid unnecessary risk. Remember, sometimes the best trade is no trade at all. Your goal is to let probabilities guide your decisions. You'll see your performance improve over time as you stick to these guidelines, protocols, and principles. Now, I know most of you may not have enough data to define probabilistic scenarios for your own systems. That's why I've created these protocols for you. Not for you to blindly follow, but so you have a framework. These are based on my own data collected over the years, and they've helped define the probabilistic conditions I work with. Now let's move on to the next slide and talk about low probability London kill zone conditions. We know that the London kill zone provides good opportunities, but at the same time, we're aware that not every day is ideal. Some conditions significantly lower the probability of successful trades, and recognizing those scenarios can save you from forced trades and potential losses. Let's talk about some key conditions you should avoid. My recommendation if you want to stay away from low probability trades. The first is after a series of 3 consecutive bullish daily candles. What this means is, if the market has already printed 3 bullish daily candles in a row, it's better to avoid taking long positions during the London kill zone the following day. Why? Because the probability of reversal or consolidation increases after we've seen an extended swing. Price printing 3 consecutive bullish candles makes further upside less reliable. Now, this isn't a definitive rule or an absolute fact. This is just a protocol for me. It tells me to be more vigilant and conscious of the fact that maybe I should lower my risk on that particular day. Or if I have enough data backing this, I may avoid trades altogether during these conditions. So based on that data, I'd follow this protocol and not take any trades. The second protocol is similar, but in reverse. After 3 consecutive bearish daily candles, avoid short positions. That's because the market might start to retrace or consolidate after such a move, which reduces the effectiveness of a bearish setup. Again, this doesn't mean the market always works this way. As I said earlier, nothing is certain or absolute. Sometimes the market will leave you behind because you chose to stay out based on these protocols. But that doesn't mean you truly missed out. In the grand scheme of things, following your data is the better decision. Ignoring that could reinforce bad habits and lead to more losses over time, especially if you start trading conditions your own data advises against. You need to understand that nothing is black and white. All of this falls into the gray area. Even if your data suggests these are low probability conditions, it doesn't mean you'll be wrong or right 100 out of 100 times. What matters is being right more often than not. If you're right 55 out of 100 times, that's enough. That's what makes these low probability conditions, statistically speaking. It's simple math. There will be times where the market gives you a winning setup on a low probability day. You might avoid it, then see it play out and feel frustrated. But instead of freaking out or blaming me or the protocol, remind yourself, this is probability. You can never be right 100% of the time. There will be days you're wrong. There will be days you're right. The key is to be right more often than not. That's exactly why I've given you these protocols. They're backed by my data. Still, take all of this with a pinch of salt. Test it for yourself. Don't follow it blindly. If you do, you'll start second-guessing yourself. That kind of hesitation will mess with your execution and lead to inconsistency, which is the last thing you want in trading. Now, enough of that. Let's talk about the rest of the conditions to avoid during London. The third one is after an extreme FOMC event. When the FOMC causes an extreme range, the market often consolidates afterward to digest the move. During these conditions, price action can become choppy and unpredictable, making it a low probability environment. Fourth, the day before the NFP, non-farm payroll report, is typically a risk-off environment. The market tends to be cautious and range-bound, making it harder to find high-probability setups. So it's better to avoid trading London, or even the entire day, around NFP. Next, if the economic calendar shows multiple high or medium impact news releases during the London kill zone, it's best to avoid trading during that time altogether. Another condition is if the Asian range forms an expansion profile, meaning it's already broken out, is trending, and exceeds 40 pips. In that case, the London kill zone is less likely to provide clean setups or fresh opportunities. The move has likely already happened, reducing the potential for further expansion or swing continuation. Also, if the Asian session does not show clear consolidation, meaning the price action is erratic or directionless, then it's another sign to stay out. We know that a consolidated Asian range gives us a strong foundation for London's expansion. Without it, the market lacks structure and setups become less reliable. And lastly, the absence of a candle range or a clean CRT setup is another red flag. You can probably guess why. Let me say this one last time. While these are strong guidelines, they're not fixed rules. You can adjust and play with them based on your own trading data, experience, and understanding of the market. Moving on, now that we've gone through the lower probability conditions, let's finally talk about the high probability conditions that we should definitely be trading in. These are the situations you want to prioritize in your trading plan. A key condition for high probability trades is when there's been a recent reaction to a high time frame key level. If the market has recently reacted to a key level on a higher time frame and hasn't yet reached an opposing key level, then the London session is likely to offer us a strong setup or a clear opportunity. This creates a clear directional bias because we know price is often drawn towards the next liquidity zone or key level. Another condition is when the Asian range is visually consolidating and stays under 40 pips. A consolidated range, meaning price is moving within a tight, predictable band during the Asian session, signals a strong foundation for the London kill zone. When the range is less than 40 pips, it suggests the market is building liquidity. This is something the London session can exploit through clean expansions and breakouts. The presence of a clean candle range, or CRT, is also a major signal. A well-defined candle range gives us a clear level for price to either respect or break through during the London session. We use this structure to guide our setups and frame logical entries based on current market behavior. Another high probability condition is the presence of a higher time frame key level. A daily, 4-hour, or weekly key level adds significant weight to our setups, especially when price is interacting with or approaching that level. And last, but definitely not least, the one I always talk about, is a clean higher time frame draw on liquidity. If there's a clear liquidity draw visible on the higher time frames, then the London kill zone becomes an ideal session to trade. Now, do you know why these conditions matter? Because high probability conditions like these are aligned with the structural framework of the market. This alignment increases the odds of success in our favor. They provide clear-cut direction for price movement, create predictable setups that match our trading edge, and reduce uncertainty. This allows us to make more confident decisions and follow a much clearer risk management model. Now let's move on. In this slide, we're going to talk about the protocols and conditions that make a setup high probability. The ideal conditions and setups that give you the best chance to trade successfully during the day. We're going to go over those now. The most critical factor in creating a high probability setup is aligning it with the higher time frame directional bias or the higher time frame draw on liquidity, particularly on the daily and 4-hour charts. This ensures that your trades are backed by the broader higher time frame context and the larger market picture. Now here are the key components of high probability setups. First, clean order flow. You want to look for clean order flow where price is clearly rejecting highs and breaking lows, or rejecting lows and breaking highs. This structure confirms the market's directional bias and reduces ambiguity in your decision-making. Second, clean higher time frame draw on liquidity, and I don't even need to explain this one anymore. You can probably guess why it's so important. Third, SMT divergence, though this one is optional. SMT divergence can add an extra layer of confidence, an extra layer of confluence to your setup, which further increases the odds in your favor. Basically, you're looking for a discrepancy between correlated pairs that indicates where smart money might be positioning. For example, one pair might make a higher high while another makes a lower low, which signals a lack of symmetry. That non-symmetry can suggest market maker activity, manipulation in price. You can then position yourself in the same direction as the market makers and capitalize on the expansion or the reversal. Again, this one is optional. Next, you want to see a strong price-based narrative. This is followed by a strong, clean, and cohesive, logical time-based narrative. Also important are the 4-hour candle range and the 4-hour key level. All of these elements add more weight to your trade setup. And last but definitely not least, the most important one is the key time. You might have all of those higher time frame factors and metrics, but they must align with each other at a key time. If they don't, they lose significance and become redundant. Now moving on to the next slide, let's break down when to look for buy setups. These guidelines and protocols will help you highlight the conditions that make bullish trades more favorable. Now, for sell trades or bearish ideas, you simply need to look for the opposite of what we discuss here. I'm going to be showing the protocols and guidelines for buy trades, and for sell setups, you can just reverse them yourself. So when should you look for buy setups? To maximize the probability of success in your long setups or buy trading ideas, it's essential that you align with the broader market context, structural elements, and correct timing. One of the key factors is seasonally bullish periods of the year. We know that certain times are naturally more bullish due to seasonal trends. You'll want to check the seasonal chart for your respective pair or instrument and look for buy setups during the periods where bullish seasonal tendencies are historically stronger. I've already made a chapter on this, so go watch that if you're unsure what I'm talking about. Next, look at whether the current or next quarter is expected to be bullish. You should do your quarterly shift analysis. Again, I've made a chapter about this, so you can see whether we're expecting a bullish or bearish quarter. If the next or current quarter is expected to be bullish based on historical data and your analysis, then you should start to look for buy setups. Always align this with the prevailing macro narrative. Another important factor is price reaction to a daily or 4-hour key level. When price reacts to these levels with bullish confirmation, it's a strong signal to consider long trades on the lower time frame. You also want to see a clear, unobstructed path toward higher time frame liquidity. The best buy setups occur when price has a clear path toward that draw on liquidity, and there are no significant obstacles, like resistance levels or opposing key levels, in the way. In those situations, the chance of a successful move increases, and you can get a clean, explosive expansion. As for ideal days for buy setups, Monday, Tuesday, and Wednesday are generally the best. Mondays help establish the range or test key levels. Tuesdays tend to expand on Monday's movement, and Wednesdays often deliver strong trending moves with higher volume. If the Asian range is smaller than 40 pips, that tight consolidation signals liquidity building, which sets the stage for a potential bullish expansion during the London or New York session. So keep that in mind. Then, when a 4-hour candle breaks previous candle high PCH, after a period of consolidation, it often marks the beginning of an expansion phase. And last but not least, key times of the day matter. You know what those key times are, and if you don't, go back and watch the time chapter I made. Here you can see an example of a setup. On the left-hand side, we've got the 4-hour time frame, and on the right, the 15-minute time frame. Based on our higher time frame daily and weekly analysis, we've determined that our draw on liquidity and our directional bias is to the upside. You can see this high right here, which represents our higher time frame draw on liquidity. Now, our objective on the 4-hour time frame is to first build the time-based and price-based narrative. Based on that narrative and the weekly profile, you can see that price formed a low, not exactly a range, but a clear swing low, just above this rejection block or key level. What happened on Tuesday is that price came down and took out Monday's low, then tested the rejection block with this particular candle. This candle is the 5 a.m. candle, which leads us to believe it's likely to be a high probability CRT as well. It didn't just take out a swing low and major liquidity, it also tested a key level at a key time, and our draw on liquidity is still higher. To frame a setup from there, what we're going to do is wait for the candle range low to be purged at a key time during the London kill zone, maybe during the 9 a.m. or 11 a.m. time window in the close of that zone. Then we'll frame the setup and target the candle range high and eventually the draw on liquidity above. You can see that's exactly what happened. Price took out the candle range low, and afterward you had a Model 1 entry in the form of price closing above the down close candle that took out liquidity below the range. Once price closed above it, it turned into an order block. Price then tested that order block and expanded higher. This is how you're going to frame a setup. You're going to classify probabilistic scenarios and conditions based on the protocols, guidelines, and principles I've given you. This is one example. If you want more examples, go watch the trade breakdown section.
Would you like to earn up to $10,000 just from sign-up bonuses? How about copy trading alongside professional traders like myself and these experts right here? With ByteFi, it's easier than ever. That's not all, there's no KYC required for all regional users. Plus, you'll enjoy a lifelong 20% cashback on every trade you make. And when you sign up, you'll also get a 10% deposit bonus. This totals 30% of your total trading budget. The link is in the description below.